So I'm standing here with Rob Morgan. He's chief market strategist at Fulcrum Securities. Got $1 billion in assets under management. Let me ask you about, you and I were talking during the break. What do you think of the situation in Europe? Because we've been so down on it. And today, just because Merkel, Sarkozy, and Papandreou come out and say everything's cool, everything's not really cool, right?
Well, Matt, I tell you, I think our 19% slide on the S&P in August, we were pricing in a disorderly default by Greece. And so if we get anything other than that, and I think we will, I think we're probably going to get a Greek default. But if we get an orderly default, as Merkel has said she wants, or if it's something even better than that, I think the market might continue to rally from here based on
What do you think about the economic concerns here in the U.S.? I mean, this morning I heard Ed Yardeni say if we get a double-dip recession, might as well just call it a depression. David Rosenberg saying we are in a depression.
Right.
It doesn't look bad. Look good. 25% of 6-year-olds in this country living below the poverty level.
Right.
On a day when we're up 150 near the close, we got to remember that, right?
We went more defensive on stocks a month and a half ago because the odds of recession have risen. But at the same time, Matt, there are so many indicators that are contrary to a recession. Steep yield curve, corporate profits that are great. The ISM index, manufacturing, up 2 weeks ago for the 25th month in a row. Last week, the Labor Department saying jobs posted is at a 3-year high. Those are all very inconsistent with us going into a recession. Yet at the same time, we're in the risk management business, and so we did get more defensive in our stance.
Insider buying to that, and also corporate buybacks. We'll talk about that. Dell coming out yesterday. It's going to buy back fully 1/5 of its shares out, and actually Seeking Alpha had a great story today saying they could buy 25% and still be sitting on tons of cash.
That's the key, man.
CEO saying the same thing. He wants to buy back shares and raise his dividend.
There's so much cash out there, and in some ways that's a contrary indicator that cash is eventually going to be put to work, and we're seeing some of that today. These instances that you're pointing out, and if corporate CEOs are buying back stock, that says a lot about what there's some confidence here, even with all this talk about recession, depression, what have you.
Rob, back in August, you were very defensive, you were saying, with your portfolio, but you also said the market was probably pricing in that 19% slide, a disorderly default by Greece. Well, it looks like, at the very least, it's going to be orderly if and when it happens. Do you get overweight at this point, or do you get a little bit more aggressive now with your stock allocation?
I think we're still in the bottoming process here. I would definitely be looking for an opportunity to get a little more aggressive or to overweight stocks. But Matt and I were talking during the break. 1190 on the S&P. These levels that were great floors for us when we were going down. 1250 on the S&P, 1190 on the S&P. Now, unfortunately, they're kind of ceilings going up, and maybe some of that was why we saw this rally cut off today, right just shy of 1190, and all the way up to 1250. It's gonna be tough for stocks, but eventually I think that getting more aggressive makes sense, just not right now.
Okay, you're a cautious bull out there, which brings me to Julie. Julie, I mean, clearly you heard Rob right there sounding a little cautious, but there's still plenty of bearish sentiment around out in the markets.
There is. One of the ways that we measure it is through Investors Intelligence and their survey of financial newsletter writers. They come out with this weekly, and it looks like we've got the highest bearish sentiment since 2009, March of 2009 to be exact. So bearish forecast now at about 41% of the total, bullish forecast about 36%, and those calling for a correction, that actually has slipped a bit. It's at about 24%. This, you can combine it with a lot of bearish sentiment out there, not just obviously on the part of people in the financial community, but by regular Americans as well, as some Bloomberg poll numbers showed today. A lot of dissatisfaction with what's going on in Washington and how the jobs crisis is being addressed. I'm curious, Rob, how much you pay attention to the various sentiment indicators. Are any of them contrarian indicators as far as you're concerned?
Oh, absolutely, Julie. It's interesting. You pointed out that we're getting the highest bearish reading on one of those indicators since March of 2009. And what happened in March of 2009? That was an inflection point. That was the bottom. So, just hearing you say that, and here I am saying it's too early to get aggressive and overweight stocks. Now I'm thinking maybe I better reevaluate that. It is a contrary indicator in my opinion, and that's very positive.
On the other hand, on a day when we're being so optimistic about what happens in Europe, keep in mind one of the huge problems with all of those countries is that most of them are democracies, right?
True.
I mean,
Yes.
the voters can change anything, and in Greece, maybe even a revolution, an overthrow of the government could change the situation there because they're not thrilled with the austerity packages.
Right.
Neither are the Italians, and the German voters, frankly, aren't thrilled with paying for everything. A disorderly default, or even worse, could happen at a moment's notice. How do you prepare for that kind of risk? Do you buy gold here?
Well, and once again, I mean, being defensive makes sense. Gold, I would
being
probably
defensive like telecoms and utilities and equities, right?
Well, yeah, defensive type sectors perhaps like that. Gold, we're probably past the point. You probably should have been buying gold at the beginning of the year if you're going to buy gold.
I know I should have.
It's probably a little bit late for that, but. I think that, as I said before, I think the S&P 500 really priced in a disorderly Greek default, and
that's it, 20%.
I think so, and anything better than that, and I do think it will end up being better than that. It still could be default, but I think we start to see some type of rally at some point in time.
All right, so what do you want to own if we see things deteriorate in a more orderly way in Europe, and if we don't see a recession here, what stocks do you like?
So my three favorite sectors are energy, materials, and healthcare. And I got 3 stock picks in each of those sectors. I've got Gilead Sciences and healthcare. I've got CF Industries and materials, and Chesapeake Energy and energy.
I notice the phrase "very cheap" by each one of these picks: Chesapeake Energy, CF Industries, and Gilead Sciences. If we are headed into a recession, and the credit markets, as Lisa and John there point out, are pointing in that direction, are they still very cheap? If the E comes down.
Right. Well, first, I would disagree that the credit markets are pointing to a recession. Even though, as John said, the yield curve has flattened somewhat, it's still very steep.
It's got to invert?
It's got to invert. And, back to World War II, every recession has had an inverted yield curve. It's been, not every recession, but there's a very high correlation. We're not there yet. So I wouldn't say that. But if in fact, I did say earlier, the odds of recession have gone up. We've gotten more defensive. And sure, could those E's evaporate and those stocks get a little more expensive? They could. At the same time, with these stocks, you got a lot of margin of safety there.
Where do you think we should be seeing PE ratios right now? I mean, as we go into a higher odds of a recession, it's going to be a lower number than the historical average, right?
So right now on the S&P 500, we're right at about 11 to 12 times earnings. The PE ratio of 11 to 12, depending on what you think earnings are going to be. In a low inflation environment like we have now, 15 is the historic norm, and in some periods it's been 20. So in some way, we only get those single-digit PEs when they're high periods of inflation, or periods of high inflation, which we're not seeing that.
If you're going into a depression, you might expect to see also a low number there.
My gosh, I think yes. Your previous guest, I think, has been calling for a depression.
I don't want to be so downbeat on an up day.
Right.
I mean, I know we closed up. I know there are green arrows across the board, but we got to try and keep the bigger picture in mind here.
And as I said, we're in the risk management business, so getting more defensive, cutting an allocation to stocks certainly makes some sense.
Got it. Well, we appreciate you spending some time with us, Rob. Thanks so much for driving by. Rob Morgan, Chief Market Strategist at Fulcrum Securities.